So let's just look at this fall in oil price. How does that affect reserves? We've recently, well, the end of last year, saw a very large drop in oil price. How does that actually affect reserves? Well, in reality, it can reduce reserves, it could have no effect on reserves, or it could increase reserves. So directly having a fall in reserves value does not necessarily mean that there will be a corresponding fall in reserves. In every case, of course, the value of those reserves will decrease. So let's just quickly run through some of these. In a gross and working interest terms, it will likely reduce reserves volumes due to some reserves projects becoming uneconomic, sub-commercial, and therefore moving from reserves into contingent resources. Remember how we talked about that? So some things will just move out of reserves and should move into contingent. It may well affect the economic end of life. In other words, that point at which the field becomes uneconomic moves forward in time. So we produce less before the field becomes uneconomic, therefore there will be a reduction. In this part of the world, and in the Middle East, and in South America, and other parts of the world, we are often governed by what's called PSCs, production sharing contracts. They're in places like Indonesia and Malaysia, here in this part of the world, and in many other parts of the world too. In a net entitlement type regime, which is a PSC regime, a decrease in oil price will likely increase the reserves due to increased cost oil. And I'm going to run through that a bit later on, so have that thought in mind. But in those sorts of contracts, in actual fact, we may well get an increase in oil volume. But we'll come to that in a minute. So let's just quickly run through some of this impacts of price. So here we've got a field, we've got our economic limit, we've talked about it, we've got some part of that is sub-economic, and we have our contract limit. So we've got reserves booked down to our contract limit, and this is, if you like, our previous reserves estimate prior to a fall in oil price. So it's all down to the commercial limit. We have reserves up to that limit, and we have contingent resources on the other side of that limit. And just a note for you to be aware of, but you'll note that over here some of these contingent resources are economic and some are not economic. So just something to bear in mind, that when you're looking at contingent resources, they may or may not be economic. Different subclasses which may or may not be declared, they're not required to be declared in many cases. All depends on what is being booked by that oil and gas company. We've had a decrease in oil price, so the value will have decreased, but in actual fact, because the economic limit is not, you don't drop below the economic limit until after the contract limit, in this particular case there wouldn't actually be a decrease in reserves for this particular asset, because the contract limit has not changed, the reserves volume to that contract limit has not changed, it's just that the economic limit's gone up. So here there will be no change to reserves, but the value would decrease. Here there's a further drop in the oil price, and now you can see that the economic limit's gone up to here, and in here now we have reserves that are now, volumes that are now sub-economic. They're not economic, so they would move into contingent resource. So now we've got contingent resources. So something else to think about contingent resources is here we've got contingent resources that are all sub-economic, but in this case they're sub-economic up to the contract limit, and we've got sub-economic post the contract limit. Again, different types of contingent resources. Contingent resources contain all sorts of different things, and something perhaps you need to be aware of if you're looking at companies that have contingent resources. There's quite a lot of different sorts of contingent resources. Okay, just a few words now on the net entitlement issue, or those reserves related to contracts which are production sharing contracts. So a fall in oil price can and usually will result in an increase in reserves. So why? The reason is that oil companies are required to report net entitlement reserves based on contractor revenue. And the contractor revenue is actually calculated based on cost recovery and project and profit share. Cost recovery is basically a mechanism whereby the company can recover its costs. So its costs it's spent on its operations and on developing the fields, and it can recover it in terms of barrels. And the profits is, of course, that company's share of the profits. If you think about it, if the oil price is lower, we'll need more barrels to recover the same amount of costs. So we've spent all this money, we need to recover it, and we'll need more barrels because each barrel is worth less money. The contractor profits will be reduced, but generally this is outweighed by the increase in cost recovery barrels. So you can see here that if I've got an example, $100 million in costs, I've got my net entitlement at $100 per barrel. I would get 1 million barrels. I needed 1 million barrels to reclaim my $100 million in costs, and I'll get some profit share. If the price of oil drops to $50 a barrel, now I'm going to need 2 million barrels to get my costs back. My profit share would have gone down, undoubtedly, but the decrease in profit share usually does not equal this. It's usually much less than this. So you end up with a net increase in reserves. And there's just a simple diagram just showing you kind of what happens. So here at $120 a barrel, I would expect to get maybe 22 million barrels. And then if it drops to $40 a barrel, I'm up to maybe 35 or something million barrels. So that's the sort of impact that price has in a PSC environment. So what's happening at year end 2014? First of all, companies that are reporting under the SEC rules must use a fixed price of $101.30 per barrel for Brent crude. So that's the average first of the month price for 2014. So that's the price they'll be using in their economics. Of course, companies reporting under the SPE system or the Canadian system or various other systems can use any reasonable oil price forecast. And that'll be whatever is their forecast. So let's just have a look at some forecasts, some examples from year end 2014. Here's the SEC constant price, $101 per barrel, sits right up here. And these are some of the forecasts from various consultants. This is the forward strip price, the ICE price. And you can see that compared to the SEC, all these forecasts are much, much less than the SEC price for 2014. And it's not until you get to 2020, 2021 that these prices get anywhere near the price that was used by all SEC listed companies. So what about in 2015? What might be the SEC price in 2015? Well, it might be down here at $60 or below $60 a barrel. We don't know. I'm only guessing. And you can see that there's going to be a huge change for companies listed on the US stock exchange. Major change for all these big companies because there's going to be a big change in the price. In terms of forecasts, well, time remains to be seen, but probably those forecasts may come down a bit. We don't know, but that's probably what's going to happen. So let's just have a quick look at what actually happened to the price of Brent. This is first of the month averages. So you can see the SEC price. So it wasn't until, about September or October that the price really dropped down below $100 a barrel, and then of course dropped down sharply. That's why we had this SEC price right up here. You can see this is the prices up until April that we've been having between about sort of $55, $60 a barrel, and that's the forward strip price. So you can see when I sort of said the price might be about $60 a barrel, yeah, probably might be that for the SEC companies, something in that order. What reasonable forecasts will be as of year end 2015 remains to be seen. So what do we make out of all this? Well, oil reserves value will always decrease with decreasing oil price, but reserves volumes may or may not decrease depending on the type of petroleum license. So are we dealing with a concession, which is common in, say, Australia, Europe, the UK, North Sea, all those sorts of areas, the US? The timing when the economic limit is reached, is it pre or post the license limit? So it'll depend on the projects. and then really the type and magnitude of marginal future projects that may become sub-economic at a lower price. So kind of what is the mix that this particular oil and gas company has in terms of projects that are sitting on the margins. And obviously, I think we're all aware that a lot of these shale gas type projects, shale oil type projects in the US and whatever, are ones that obviously are being looked at very carefully. A lot of oil companies have deferred development. You've probably seen that. Really, why are they deferring development? Usually because a lot of that development is sub-economic at the current price. So they're deferring it, pushing it back, and that will probably mean that at least a large majority of those projects will probably have to move into contingent resources. So that will result in a decrease in reserves.
The clear answer, Tony, to the premise of your presentation, and that is whether the reserves are a proxy for value, true or false, the very clear answer is, it depends.
I guess you're right, it really does depend. I think if you're only looking at reserves, you need to be very careful, because as we have seen today, reserves will vary depending on things other than purely price. It will vary depending on, in particular, licenses, and that's been a big issue in the industry for a number of years, and I know the big giants, the Exxons and so on, have complained about this in the past because they've felt it has been confusing for investors. In other words, it had an increase in reserves or a decrease in reserves, perhaps more the case, and that may or may not have anything to do with the value.
But you see, Tony, I mean, from an investor's perspective, there are so many variables here that you actually start to wonder whether looking at reserves is of any value at all to investors.
Okay, I think the way all companies look at reserves, they do see them as important, and they're certainly a fundamental part of all annual reports and lodgements and so on. Reserves represent the future economic production from an oil and gas company. So they are a fundamental part of the way we do our business. The link to value, yes, can be difficult to determine. Nevertheless, if I'm looking at an oil and gas company, and I see year on year those reserves are decreasing, that to me is still a red flag. I still need to think about, now, what is that oil and gas company doing? Is it actually shrinking in size? Because that's what it would appear to be doing so. So, I mean, I think there is a place for reserves. They are important. They're important to us. They're certainly important to the oil and gas companies. And I think as investors, it is important to look at them, but you need to look at them carefully. And you always, of course, need to look at the value that you're looking at.
Still, excuse me for being a cynic, but frequently it's impossible to make an apples for apples comparison to establish that downward trend, to use your example, because frequently then new variables are introduced, or previous assumptions are then changed and different assumptions are introduced. Do you find this an issue in your business?
Okay, I mean, yes, I mean, it can be, but let's think about this very carefully. I mean, one of the things that is often a requirement in reporting is auditing. So you certainly can't just go and randomly change things to kind of make the picture look somewhat rosy, because if you do start doing that, somewhere along the line, you're going to get caught out and you're going to be in a lot of trouble. And of course, companies have been in trouble in the past. If you're doing something like an IPO, then there are QPRs, qualified professional reports, that are actually required. So there again, basically an auditor goes in and confirms what you have done is reasonable. So sure, there is a little bit of scope to be a little bit more favorable or unfavorable in terms of your assumptions. Nevertheless, they do need to be reasonable, and they could well be audited.
Yeah, hi. Two questions on some of your calculations and some trends in the industry. The first one is, you talked a lot about the influence of price, but what about technology? So, for instance, the trend for EOR, and also if you look at the shale oil and thing in the US, that's been a success because of the infrastructure, the railways and the pipeline. So that's the first question. It's what I call the technology. The second question, and leading back to one earlier, in Australia in particular, there's a lot of talk about the JORC code in the mining industry. having the bigger companies actually put what I call commercial assumptions on the table, which you'll say in the oil and gas industry is keep secret. What do you think the trend is going to be for the SEC and the SPE and those organisations?
Technology has and will continue to have a significant impact in the industry. I mean, the whole growth of the unconventionals has been as a result of fracking and the development of fracking technology, as well as price. It's interesting, a lot of technology is actually related to price. And we can see that now, of course, with the huge drop in terms of development activity in the unconventionals. It's very related to price. And historically, I mean, some of the big technological advantages, things like steam floods for heavy oil, has been hand in hand with price. So if the price stays low, technology advances will probably be slower. Price comes up, undoubtedly new technologies will come in, and that will have a significant impact, I think, as the industry moves forward.
Second question was in relation to the impact of the way that JORC looks at the industry in the mining sector, what the forecast is for the society that you're both members of, the petroleum engineers. What are you guys going to do in terms of the standards that you set? I wasn't going to use that word because it scares them. So I was kind of going to weave around to see whether they'll say, oh, we'll be more transparent in the future. Let's see.
Okay. I mean, the SPE, out of interest, is currently looking at its guidelines because it was last updated, it was 2007, then they did some applications in 2011, but it's overdue. So hold that line. The SPE is currently looking at it. Now, in terms of more transparency, in terms of commercial type information, I don't believe that the SPE will be looking at that. I think it would see that outside of its jurisdiction. The SEC, on the other hand, I'm not so sure. The SEC, of course, have recently changed their guidelines, and they've become far more consistent with the SPE. But of course, the SEC already has this kind of standardized measure in terms of value, reserves value. So I'm not sure that I'm seeing the SEC going to change a great deal in the near future. I think they'll probably keep much as they are.
Eddie, you agree? You're nodding?
Yeah, I agree with Tony. I think information such as that, transparency is something that generally we try to strive for, but then like with the reasons that we mentioned, companies tend to hit a bit of a roadblock or walls all of a sudden when they start talking more transparent information and all that. So I think I'm with Tony on that. Slowly, maybe getting there, but it's going to be very slow, really, if anything.
I just want to check whether there's any accounting standards or regulations to the frequency of valuation of these reserves. Because we've been talking about reserve been going out and down, but is there actually a accounting standard to how frequent this needs to be revalued? Because this will definitely have an impact on the balance sheet size, right?
Well, most stock exchanges have a requirement that if there is a material change to the reserves or value, that thou shalt report it. So I see John Leck is nodding here, so that's a requirement in Singapore Stock Exchange. Certainly in the Australian Stock Exchange where I've dealt with.
But only in the annual report, or is there actually an FRS that?
No, there is a process. You're quite right. If there is a material change to the reserves, you have an obligation of disclosure to disclose that material change.
But you can't give us a time frame. Or how frequently?
It really depends on the materiality of the change. So, for example, if that major drop in oil price occurred mid-year, then oil and gas companies would have an obligation within a reasonable time frame after that to inform their investors of what that material change, how that has affected the reserves.
Just want to know, what is your point of view that would you recommend companies to ramp up their production, flooding the market with supply, or cutting costs, cutting capex as a method of maximizing shareholder value?
I get the fun questions. I think the fundamental point, you kind of answered it at the end, is maximizing shareholder value. I think in this current oil price environment, people would have views, let's say, delay production. But then which company has the luxury of delaying production, which translates to cash flow tomorrow? And equally, cutting costs. I mean, I hate to say this, I've got a good number of companies I know they're trying to cut costs now, which they should have done when it was a $100 world. So the bottom line, to answer your question, is basically maximizing shareholder all the time, not when the oil prices move down. Yeah, so I think the answer is both, if possible. Thank you. Yeah.
I guess underlying that is the question, if you were an oil and gas company, would you now be trying to make up with volume what you miss out in terms of value of the oil price?
Well, it's that old equation, isn't it? I mean, firstly, oil and gas companies, of course, are hurting. They're not getting the income that they were expecting. So how much disposable income they have, of course, to ramp up development or to do these sorts of things. I think what we're actually seeing is, of course, that companies are, in fact, deferring development. They're pushing it out. So I think the answer to your question is they've obviously done the analysis themselves, and they believe that to maximize shareholder value is at the moment to defer development and potentially see production decline.
And in a word, is there any truth to the rumor that the oil price is down so much just to peeve Vladimir Putin and Russia?
Well, that and the US shale gas producers, I think.